High yields in emerging markets are drawing attention. But with growing divergence, how can advisors spot the real opportunities? Hi, I'm Mauro Favini. In this video, I'll explore why emerging market debt has become a more strategic allocation, where we're seeing durable income opportunities today, and how to approach country selection in local markets and in US dollar-denominated debt. I think the key shift is that emerging market debt is no longer just a tactical trade driven by cycles. It's increasingly a structural opportunity. Historically, advisors and their clients have diversified globally in equities, but not in bonds. And that's part why emerging market debt has been underallocated. What changed is that today, the opportunity set is harder to ignore. You have countries like Mexico offering high real yields, in some cases, meaningfully above what you can earn in developed market countries, but with policy frameworks that have improved significantly. The example is powerful. Policy rate in Mexico is 6.5% with inflation at 4.5%. That's 2% real yield. In the United States, you have policy rate at 3.75% with 3.8% inflation. And these real yields come along with a combination of stronger fundamentals and improving policy frameworks. So instead of asking when to allocate, the better question is how much exposure should I have over time? For long-term investing, EM debt can play three roles: a source of income, a diversifier, and a way to access a broader global opportunity set. I think it's more a question of where the opportunity has shifted. In parts of high yield and developed markets, spreads have compressed significantly, so the margin for error is lower. Income is still there, but the spread cushion is thinner. In emerging markets, you still see pockets where yields remain attractive relative to fundamentals, particularly when you look across countries and sectors. So the opportunity in emerging markets hasn't disappeared. It's just become more selective. What looks similar on the surface can change very quickly fundamentally. A good example is what we've seen recently between Kenya and Angola. Historically, Kenya traded with a tighter risk premium, at one point about 200 basis points inside Angola, reflecting differences in fundamentals and market perception. The conflict in the Middle East and the related oil shock changed this dynamic very quickly. Angola, as an oil exporter, benefited from higher prices, while Kenya, as an oil importer, faced a deterioration in its external balances. Same as a class, very different exposure to the same shock. As a result, these two credits ended up trading much closer together, almost flat to each other, and that repricing happened fast. So the opportunity today isn't just about finding yield, it's about understanding how macro shocks can reprice credits differently, and being selective about where the fundamentals are improving versus where the risks are building. Because in emerging market, yield alone doesn't tell you the whole story. What you're seeing more and more is dispersion, and that is really what is driving the opportunity set today. So the real opportunity isn't chasing beta exposure, it's in being selective and identifying where the market is mispricing risk. That's where the alpha really is. Dispersion in emerging markets is being driven by very different policy choices and external conditions across countries. Countries are no longer moving in sync, and that is a big change from the past. Take Mexico. They moved early to tighten policy, stabilize inflation, and build credibility. Now they have the flexibility and can ease into a stronger macro backdrop. Other countries are still dealing with higher inflation, weaker fiscal dynamics, or external vulnerabilities, which creates a very different risk profile. Same as a class, but very different trajectories underneath. That divergence means the gap between winners and losers is wider than we've seen in many years. This is not just about where yields are, it is about what's driving those yields. And that is why being selective matters. Broad exposure might average that out, but it can also dilute the opportunity. A more selective, country-by-country approach allows you to lean into the better stories while avoiding areas where the risks are not being fully compensated. Because in this environment, dispersion creates the opportunity, but only if you are selective. Building on dispersion, the key distinction is not just risk. It's what kind of opportunities you're trying to access. It comes down to credit risk versus currency risk. With US dollar-denominated bonds, you're primarily focused on credit. You're asking a straightforward question. Can the sovereign or corporate repay it in dollars? That tends to be a more familiar framework for many clients. You're taking country risk, but not currency risk. With local currency bonds, you're adding another dimension. You're not exposed to a country's monetary policy cycle, inflation dynamics, and currency valuation, which can actually become more a source of return, not just risk. For example, if a country has gone through a tightening cycle and is offering high real rates, local bonds can provide both carry and potential currency appreciation. So you're not just earning yield, you're participating in the macro adjustment. And that is the key shift and where the opportunity becomes more interesting. Instead of thinking about currency as something you always hedge away, it can actually become an intentional part of the investment thesis. Currency is not just a risk, it can be a return driver. Both segments can play a role in a portfolio, but they serve different purposes. The right mix really depends on what kind of diversification and return profile the client is looking for. Because at the end of the day, you are the one choosing what risks your clients will be paid for. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.